This is your LMAX exchange technical update for Tuesday, February 14th, 2017. Euro dollar. So this latest break below 106 in the euro does put the pressure back on the downside, and the focus now is on a potential retest of the 14-year low from January at 103.41. At this point, it would take a break back above recent highs around 107.15 to put the pressure back on the top side. But again, it looks like the market is wanting to top out now in favor of a bearish resumption towards that 14-year low at 103.41, which guards against more significant support at parity further down. Sterling dollar. So cable has been confined to some choppy trade over the past several sessions, mostly consolidation after stalling out ahead of some critical resistance at 127.75, which was the December 2016 peak. At this point, we need to see clarity and a break back below recent support around 123.47, or a push back above recent resistance, which comes in just over 127 at 127.07 about, would be required for additional insight. But again, ultimately, the market is bearish while it's below 27.75, and it would take an establishment back above that level to force a more meaningful shift in the structure. Until then, the pressure does remain on the downside, and there is risk for additional setbacks below the recent support that we said that came in around 124.28 down towards 120, and eventually potentially to retest the plus 30-year low that we saw back in October of 2016 at 118.41. Dollar yen. So dollar yen saw a bounce over the past few sessions, but the market continues to be very well capped into rallies, and while it holds below 115.62, that's the high from the 19th of January, the pressure does still remain on the downside, and there is risk for deeper setbacks towards a measured move objective at 109.50. At this point, again, it would take a break back above 115.62 to take the immediate pressure off the downside. Euro Swiss. So Euro Swiss has seen a bit of a bounce, but overall the pressure remains on the downside here, with the market being very well capped into rallies and looking for a break below the 2016 base at 106.24, which guards against 105 further down. Only back above 107.60 would take the pressure off the downside. Aussie dollar. So Aussie looks like it finally could be stalling out in 2017 after rallying up and stalling just shy of 77 into some meaningful medium-term resistance in the 78 area. At this point, it would take, though, a break back below recent support, which comes in around 76.06, to confirm and accelerate declines. Dollar CAD. So dollar CAD has seen some setbacks in recent trade, most recently establishing below that critical psychological barrier at 130, but the market was not able to establish a close below the level, which does keep the broader pressure on the top side, with the hopes of potentially seeing a resumption of gains back towards recent resistance, that multi-day peak at 135.99. Kiwi dollar. So Kiwi has stalled out at just ahead of 74 in 2017. The market continues to show signs of a major top off that 2016 high just shy of 75. And from here, there's risk for deeper setbacks and acceleration back towards meaningful support, which comes in around the 68.60 area, below which would expose 66.76 further down. That's the low that we saw going back to May of 2016. SPX 500. The S&P 500 continues with its push to fresh record highs, showing no signs of a let-up just yet. At this point, it would take a break all the way back down below 22.32. That's the low from the 30th of December in 2016 to take the pressure off the top side. Again, this is a market that has shown no signs of reversing, trading just off fresh record highs and looking higher. The market should see some form of a correction, one would expect, over the coming sessions, but again, it would take a break below 22.32 to take the immediate pressure off the top side. On a short-term basis, a break and close back below 23.07, 23.06 would potentially spark a short-term reversal in this market. Gold. So despite setbacks in gold in Monday trade, the market remains very well supported on dips and ultimately is expected to trade up towards the next key measured move objective at 1260 in the sessions ahead. Only back below 1180 would compromise this constructive outlook for gold.